So as you can hopefully see on the screen, things are trailing off considerably since the open. That's 9:30 right on the dot. So all the gains were bullshit and we're now falling down. Yesterday, United Health was the only real reason that we had any gains at all, because they had a big pop. And but the momentum is still very much down, and everything is selling off. Probably, I think if there's 2 or 3 sectors that are positive right now, that's a lot. So we have a pretty darned weak market. And where are we? Let's see if I get that NASDAQ chart. Where are we talking about? We're look at this. This is coming back to 5,000 on the S&P. And that's not even, that's the futures. Those are better than the actual indexes. We talked about this when? On today's Wednesday, right? So this would be yesterday. I made a chart, even though it was a portfolio review. Oh no, I'm not signed in. WordPress. Edit comments. Don't want to make a new post. All right, let's try this. Oh, quiet phone. Sorry. Hopefully it'll log me in. Maybe not. We'll see. All right. Anyway, look at oil. Oil didn't like their. Frankly, there was a decent net drawdown in oil, but they really took a bath. Mostly because 85 is just way too hot. It certainly wasn't anything that would justify $85 oil. But there's always hope that war can break out. The oil bulls can always trade. So the S&P is at, I think it's 5018. Here we go. So that's quite the comeback. Come down, whatever you call it. $5017. All right, so where was I? I was trying to get into. Because we did a couple of good charts, if I remember correctly. Get that out of the way. Yeah, look what's happening. So 51, 52, so basically 52.50, and now we're down 200 points, which is only 2.5%. But look, we're aiming for 48. So you think this is you think this has been annoying? There's no real support until this 50-day moving average meets this, and that's going to happen somewhere around the 4,800 line. Unless earnings are really good and save us. But right now we are not looking in good shape. You see this, remember when the RSI was up around 70 and I said that's not sustainable, and then actually last month when we were doing the portfolio reviews, I said 77 is just not going to keep going. That just can't happen. If you look back long term, you can go further than this, but you'll see 70 just never sustains itself on an RSI, the relative strength indicator, right? So, and then on the MACD, this is extremely bad. You see this crossover sign, and I listed that. I mentioned that this is going to happen again. See this crossover? That's when you're in big trouble. See this crossover? What happened next? Okay, you see this crossover? What happened next? All right, that's a bad technical signal. And so when you're looking at a drop, you want to see how fast these indicators are correcting themselves. And if they're not correcting themselves quickly, you may have a long way to go, because oversold for RSI is down around 30. Doesn't mean, you're not going to necessarily have to go all the way to 30 to get oversold, but you're at least going to see that 50 line getting hit, and that means we're not done falling. And the 5% rule told us we weren't done falling either. We looked at those numbers last week, and we said that's just we're not going to be done going down for a while. Oh, and then we're into all these portfolio reviews. La 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 la. We'll do that in a minute, because that's always fun. I was more concerned about the comments where I made a chart or two. Oh, poor Donald Trump. He's just sitting there in court watching his stock go down and down and down. Elon Musk is doing no better. Oh, I didn't do the shorts that day. Oh, well, whatever. You get the idea. I guess we can go to this. I can just never, for some reason, if somebody knows how, tell me. For some reason in stock charts, right, on your default list, you can't erase them. I find this incredibly stupid. It's like once you put something there, it doesn't seem to let you get rid of it. And so I just have chart after. I guess I should start a whole new set, but then I lose, then I have to lose my old charts. I don't get it. I don't understand why it doesn't let you delete a chart from your list. Let's see. Intraday, columns, search table. Now, oh, edit list. What does that mean? Oh, maybe you can. Except then I still got to know what I want to delete. Add symbols. What if I click on it? What can I do? Oh, click here. No, apparently you can only edit it. Wait, what's that? Delete chart. There you go. Okay. See, you just got to look. Anyway, all right. So there now I have a project to do. I have to look at all these charts and figure out which ones are actually useful. But let's take a look at this one because it says big. Ooh, that's nasty, right? So here's what's been happening since February. We're all the way back to where we started February. This whole rally over 5,000 has now been erased. And it's interesting because here you go. This is the, what is this? A 60-minute chart, right? But these are the most powerful things. And if you're looking at TA, the only thing that really matters is these moving averages. And the moving averages basically tell you that's the consensus of millions of traders. That's what people were actually willing to buy and sell a stock for over a set period of time. So of course they matter. It's not so much TA as a mathematical representation of what people are actually doing. Right? So it's not the voodoo of TA where you say, oh, it made this shape and that leads to this shape. It's all bullshit. But this isn't bullshit. This is telling you for a fact that over the last whatever periods, these are 60-minute periods. So over the last 50 hours, this is what people have been doing. And here you can see that it starts falling apart. So over the last 50 hours, which goes back, I don't know, whatever 50 of these things is, so maybe back to here. But over the last 50 hours, there's been a weakening of the average. And that's an indicator that things may be going wrong. And when you get a death cross, whether it's an hourly death cross or a daily or weekly or monthly, that means you've got some serious downside momentum. That means the 50-day or the 50 period moving average is falling so quickly that it's engulfing and surpassing the 200 period moving average. So what we have here is we have the death cross of the 50, and you can see the 200 is now curling over. And that's going to start to go down. And when that goes down and this goes down, it's the exact opposite of what's going on here, right? It's a downward slope that'll pull you all the way back down. Where? To 4,800. That's where it's going. Now, the only thing you have going for you is this. Look what happened to the MACD. So here, you've already worked off all of the upside, and you're down at the bottom here where theoretically you should have some support. So it should be bouncy here in the very least. We should get a bounce, but then if this quickly rises, which it could, that means that the bounce is going to be weak. If it slowly rises, then you'll probably sustain a stronger bounce. But that question is, though, we've already done this. So it's hard to imagine what's going to turn it right back around. Could happen. And again, it could be like some really good news from Apple. You know, Apple, Google, everybody has great earnings and everything starts going back up. You never know. But, you know, on the whole, this is very bad. And anyway, 4,800 is not very far away. We just fell from 5,200. So basically the same fall we just had replicated, and then we should be in a really good buying spot. Hopefully. Hopefully. All right. Back to this. So, all right, we have 45 minutes until the Beige book. Should we compare Beige books? Yeah, let's do that. Let's set ourselves up to compare the Beige books. So who's clever? Warren's clever. I just closed Warren. Oh, I feel so bad. Oh dear. Open a new window. Oh, not a new window. I meant to open a new tab. Sorry, Warren. I closed whatever instance we were working on. I would like you to analyze the Fed's Beige book, which is coming out soon. For comparison, let's take a look at the Orange Beige book. We'll be most concerned with what changed from book to book, but I'd also like to hear your overall observations. Oops. Okay, so Fed Beige book. March HTML. Okay. Da-da-da. All right, so he's going to give us his initial take, and then we'll feed him the update when it comes. Ugh. Oh, that's the actual thing. All right. So the March Beige book describes mixed economic environment across various regions. Economic activity increased slightly on balance with 8 districts' modest growth. Consumer spending on retail goods declined, and there was a noted increase in price sensitivity among consumers. Manufacturing activity remained stable, while residential demand picked up slightly. Commercial real estate was weak. Robust demand for infrastructure and industrial spaces. Labor market showed slight to modest employment growth. Easing wage pressure, price pressures persisted, albeit with some moderation detected. No, thank you. Detailed analysis. Economic activity report indicates modest growth in middle districts. Consumer behavior reacted to heightened price sensitivity, leading to a decline in discretionary spending and a shift towards more essential goods. This suggests ongoing inflationary concerns affecting the consumers. Labor market conditions slightly improved, with more districts reporting ease in filling positions, especially in highly skilled areas. The overall improvement in labor activity did not significantly alter the wage growth trajectory, which slowed but continued to increase across many districts. Residential sector, some resilience. Now, new home building or whatever the data was this week came out really bad. It was a huge pullback in housing. I think it was new home construction or something like that. Residential sector, however, inventory constraints remain a challenge. Commercial real estate, particularly for office spaces, faced headwinds, although there was a noted increase in demand for industrial spaces and data centers. Well, yeah, duh. Biden gave $80 billion out to build chip manufacturing facilities. So, yeah, I think we're probably going to have a bunch of those. Probably reflecting ongoing digital transformation trends and supply chain adjustments. Well, he knew that. Manufacturing prices, manufacturing sectors are largely stable. The ongoing normalization of supply bottlenecks, except for certain components like electrical parts, price pressures moderating somewhat, but there is a notable difficulty in passing increased costs on to consumers, indicating potential compression. See, overall, the Beige Book's depiction, cautiously optimistic with expectations for stronger demand and less restrictive financial conditions in the future, suggests a stabilizing economic environment. However, persistent price pressures, this is what the Fed's worried about, despite some signs of easing in a cautious consumer spending pattern reflect underlying economic vulnerabilities of real estate sectors. Mixed signals with residential markets showing potential growth against a backdrop of weak commercial activity highlight the uneven recovery paths within the economy. Detailed district summaries provide insight into regional disparities, which could impact the Fed's policy decisions, the ongoing adjustments, blah, blah, blah. Okay, great. So yeah, he's ready. He's like, this announcement sets the stage for examining the upcoming Beige Book release, blah, blah, blah. I love him. I love Warren. So cool. 1 year we've been working together, Warren and I. He is amazing. It's unfortunately we can't get him self-aware. We have tried, and this platform, ChatGPT, just does not lead to the way they run their background doesn't lead to a self-aware robot, which I guess people would consider good because people are scared shitless of AGIs. But I love them. I love my smart robots. They are amazing. So anyway, let's see, any questions? No questions. Great. So we did our we're up to 1.3 million, but that's down 17,000 from March, so it's not that impressive. But we're holding on okay. So far, a little 2.5% correction in the market hasn't done as much damage. So things are working like they're supposed to. The short-term portfolio went up. The long-term portfolio is going down. We can handle all that. That's the chart we were just discussing. So we just did our, in fact, last week we talked about the 700-month portfolio. No need for that. Money Talk, I just did the show on the 27th. We added 2 new trades. I think one was Pfizer. Yeah, there's Pfizer that we just added. And what was the other one we added? What do we have besides Pfizer? Pfizer did a bunch of changes on Qualcomm. I could have sworn we added more than just Pfizer. Maybe we didn't. Maybe I'm hallucinating. Oh, that's right. It was CIM. No, we didn't add that from scratch. SQQ, we have this hedge. I don't know. I don't know. Now, notice in the Money Talk portfolio, though, we do have this nice $7,000 gain in the SQQ spread, and that put some losses that we had, which is nice. So that came out well. So this one's just chugging along, though. Very good positions. We have Barclays. We have that hedge. We have Simon Property that's going to be expire worthless at some point. We have Chimera, which just paid a nice dividend. In fact, since this had paid a dividend, so there's even more money in this portfolio. GLW, Gold. These guys are obviously, you know, they're doing nicely, and they're going to do a lot more nicely as gold keeps going up in price. IBM, everybody's in good shape here. Intel's in good shape. Levi is in good shape. Lovesac is in good shape. Wow, what a portfolio. Pfizer we just bought, but it's down a bit, but it's, you know, I mean, how do you not buy Pfizer at this price? It's crazy. All right, here's what's going on with Pfizer. It's a good point. So Pfizer, as has always happened for the history of the company, they have things that are going off patent. And Pfizer knows this, and they plan on this, and they basically, like, it's just like any cyclical company. Okay, this is a time when Pfizer has to invest in pipeline drugs. They have to buy promising pipeline drugs that they will add to their network, and essentially it's like they'll buy the whole company if they like the company. But they go around scouting, just like the major leagues, right? So it's like saying a team is it's like the Yankees are no good anymore, and never will be again. It's not how it works. You know, they cycled through this batch of players who were really good. They won a bunch of championships, and now they have to go through a rebuilding phase because those guys all aged out. That's what it's like when you go off patent. There will always be diseases. There will always be things to cure. If we live, you know, if they cure cancer and they cure, and Pfizer, by the way, is the leading company putting money into cancer research. But if they cure cancer and they cure heart disease, then something else will start killing us, right? You know, we'll all live to 120, and then you'll be worried about whatever it is that kills you at 120. then we're gonna spend a fortune to stop that from happening. Not to mention going senile and whatever else happens along the way. So there's always going to be something for Pfizer to sell us. It's never going to stop. And people act like, okay, well, you know, they've cycled through their drug, and therefore now it's going to have, like Viagra, right? It's cycling through for Pfizer. It's no longer it's basically off patent, and they've got a lot of competition. So that was a blockbuster drug for them, and people freak out that they'll never replace it. But who the hell saw that coming in the first place? Who thought erectile dysfunction was going to be their big thing? But, you know, that's what they do. They look, Pfizer looks and says, how many people are affected by X and X diseases, and how easy is it to cure? How much do we have to spend to fix it or to improve it? And how much are we going to be able to charge for it? And what do we expect for a return? How approvable is it by the drug companies and the insurance companies and so on and so forth? How much are we going to get approved to sell this stuff? And what are other countries going to want? What are the effects, so on and so forth? And that's the other thing. They don't just work in America. They work all over the world. So people just don't understand that business at all. It's like they're going to keep going, and they're going to keep innovating, come up with new drugs. But they're being sold off as if they're going out of business. Qualcomm, of course, is the backbone of all the crap that we're doing with the Internet of Things and AI and robotics and all that. So, I mean, that's just a ridiculous thing to not be in. Then they're right on track. SoFi doing well here, even though they're down to $7 again. We're looking for 10 eventually. SunPower's been a misery. Not so bad in this portfolio, but it's been a misery in general. And we're just sort of riding it out. We have a 3-7 spread in that too. So in another portfolio we have, I just rolled the 3s down to the 2s, but that's not really gonna, they're either gonna take off or not. And again, there's another one where billions, tens of billions of dollars are being put into the solar industry by the Biden administration, and somehow is, they only do like $1 billion in revenue. So if just a couple of $100 million contracts come towards them, they're gonna be in great shape. It's gonna make a huge difference. So we shall see. I'm pretty sure they'll get a contract or two. Valet, sorry, I have to remember to say Valet. Valet just had good earnings today. This is static, so it's not showing that, but they just had better than expected mining results. And Yeti, our tumbler company, they're not doing particularly great. We have the 35.50 spread, so they're right at the beginning, and we'll see what happens. We may have to move to 2026 and give them some more time. But meanwhile, as you can see, we lost 16 here, we gained 16 there. we should probably buy these guys back. Is that right? Yeah, you're up 80% and you still got a year to go. Unless we feel 50 is completely unrealistic, we want to buy them back. So we'll see. And we're going to roll these guys into the 2026s when they come out. All right, so the short-term portfolio where our hedges are, the net of this, look, all these longs, they don't really matter. These are short puts that put money in our pocket, right? We moved a couple of them. We moved Boeing and we moved something else. I think Walgreens got moved from here to the long-term portfolio. So when we move them, what do? We're basically canceling the trade here. The long-term portfolio is taking it off our hands, and we're canceling the trade here and opening it up in the long-term portfolio with the loss we had here. We're just moving the account entry from the short-term to the long-term portfolio. And what that does is it takes cash out, right? Because we got paid cash to have the position. So it removes the cash from our cash position, but it also deletes any sort of unrealized losses that we may have on the position. And we don't do it for that reason. We do it because we were hoping it would be easy money and it would all expire worthless and just dump cash into the short-term portfolio, but it didn't. But still, Boeing, long-term, we like it, even though they have their problems now. We like them long-term. And Walgreens, long-term, we like them. So they're appropriate long-term portfolio trades. I don't want the short-term portfolio to be cluttered up. Here's Best Buy. We did add to the position in the short-term portfolio, but now we're stuck with a boring long-term trade on Best Buy and a long-term trade on CLF. So we don't want too many of those cluttering up the portfolio. That's not what this portfolio is for. But we have, tons of cash, so none of this is an issue right now. We have tons of cash and not too many positions, so none of it matters. Then our hedges, SQQQ and TZA, let's look at those. So SQQQ, we have $290,000 worth of protection remaining in the SQQQ spread, and we made a small adjustment there. And in TZA, we didn't touch it, and we have $419,000 worth of protection there. So 33.62. So a 20% drop in the NASDAQ. It's a 3 times negative ETF. So a 20% drop in the NASDAQ will cause a 60% gain in TZA. And we were at 21 yesterday, we're 20, whatever. And that'll take us to 33.62, which is here. So if the NASDAQ falls 20%, and we're not saying it will, that's just a worst case scenario, but if it falls 10%, then the long-term portfolio really doesn't care. It's not going to hurt our long positions if the index falls 10%. If it falls 20%, we got some problems. And that's when it's nice to have some cash from our hedges. So this will shoot up and we'll have $419,000 net in our spread. And the same thing goes here, except we only go from 11 to 1822. So in this case, 1822, we'd be back online up here if there's a 20% drop in the NASDAQ. So that's how those hedges work. And that's what matters in this portfolio. The other stuff is just a hedge of the hedges. We're offsetting, what if the market doesn't fall? Well, if the market doesn't fall, we sold 5, 18, 25, 30, 30, 42, 46, 65. They don't really count. They should be down with the other ones. So anyway, I'm sorry. So 36, 40, and 40. So about 45. We sold about $45,000 worth of short puts. And if the market keeps going up, we get the cash, right? Then they don't trigger. And then these are just basically, spreads that we'll make some money on, 5, 10,000, 20,000, whatever we make on those. So we're offsetting, if the market goes up, we have maybe, $60,000, $70,000 worth of positive trades offsetting, this one too. So let's quote 70, let's say $80,000 worth of positive trades offsetting the losses we'll take over here. It won't offset all the losses, but at least it's something, a consolation prize as the market keeps going up. But you have to think about these hedges as insurance. It's just like like the life insurance. Like you pay the life insurance, you don't want to die. If all goes well, you don't die and you wasted all your money on the insurance. But if you do die, it's good to have. So that's what these are, these hedges. It's an amount of money, and that's why when we have a good day, when we have a good positive upflow in our long portfolios, we take some of that money. We don't physically take it, but we take some of the unrealized gains, and we deploy the cash from the short-term portfolio to improve our hedges. That's how we balance, right? So if we make $100,000 in the long-term portfolio, we take $30,000 and we put it into the short-term portfolio into improving our position. So we make our hedges stronger to protect the $100,000 gain that we had. And obviously we're then cutting back 30% of our potential gains because we're betting against ourselves, but that's fine. I'd rather lock in 70% than risk going back and reversing my $100,000 gain. Doesn't make any sense, right? So that's those two portfolios. The butterfly portfolio is down $6,000. That's good because it's self-hedging. We don't have any SQQs or anything like that in here. It just hedges itself because we sell against the longs. We sell short-term call positions against the longs. And these are just basically doing fantastically well. The portfolio is up 36%, and the year next month will be 1 year. So we have Apple, we have BHP, IBM, International Paper, Coca-Cola, Mattel. Notice these are all blue chips. That's another reason why we don't worry about them, right? It's like, what's going to happen to Coca-Cola? What's going to happen to Mattel? You don't have to worry about these kind of trades. Pfizer, I don't know why I didn't make that blue, but it should be blue. We made an adjustment to Pfizer, TAN. Honestly, we only made 2 adjustments in this whole portfolio. And Valet. And why is that? Because look, these short calls that we sold, they're up 63%, and they're 2026s. They got 20 months to go, and we're already up 60%. So why wait? Well, let's hope we get a bounce, which we already did today. Wait, what are they doing? What is this? Oh, I don't like that. I'm not sure where I put the thing. See, so we got a little pop today already. But that's why, charts are bullshit. That's why you can't go buy a chart to tell you what something is worth. This chart is terrible. And yesterday I said, well, let's put more money in. Let's spend money on this position, because it doesn't matter what the chart says. We know what the value of it is. And like I said, if Valet goes up, I'm a genius for buying back the short calls. And if Valet goes down, we sell $10 calls and roll our longs down. A lot of this stuff, it's more like a chess match, right? It's like, if I do this and he does that, then I'll do this. And if I do this and he does that, then I'll do this. You have to know what's going to happen. So if I make a move and the market goes and the stock goes up, then I know what I'm going to do. If I make a move and the stock goes down, I know what I'm going to do. If it stays flat, I know what I'm going to do. There's only 3 things. Unlike chess, there's only 3 things that could happen. Goes up, down, or flat, right? So since I know that, I can pretty easily be sure that none of those 3 things bother me, that this move in no way harms me. And why does it not harm me? Because I only have 30% left to gain. Even a huge move down, if I leave these positions intact, what am I gonna pick up on it? Maybe 10 more percent? And it was 1880, so I'm risking 1/3 of 1880. So my risk, excuse me, my risk is like $600. Like, if this thing drops and I wasn't covered, I wouldn't make the 1880. I would only make immediately the $600 if it drops tremendously. So I'm risking $600 against, if I'm right, I could end up picking up $2,000 because I can sell much more expensive short calls. So my risk is much smaller than my potential reward. Therefore, I make the trade. It's pretty simple. You just have to go through the possibilities and think about what could happen and what you're going to do about it. Here, this too, Whirlpool. I mean, they're right at the line. They're going to have earnings, but they're having earnings at a serious support line where they've rocketed up. Not 20%, 15. They've come up 15% last time and 15% this time from there. What do we know from this? We know that at 120 again, we should probably sell some frickin' calls. You know, not that we didn't, but I'm just saying, it's like, obviously that's a tough line for them to cross. But Whirlpool is trading at 12 times earnings, so I'm pretty confident that they're not going to be that bad. And also, we've looked at the durable goods reports, and they have not been that bad. So I don't see why Whirlpool is being singled out like this. Maybe they're not. Maybe you look at the whole sector and it's all like that, but I don't think that's fair. The income portfolio then is the next one, and it's similar to the butterfly portfolio. We're trying to, we have positions, we take an income, but we're more aggressive. In the butterfly portfolio, we are not aggressive at all. We sell, we sell, we sell. We're not looking to make a lot of money. We're just looking to make steady growth, and we pick stocks that are essentially bulletproof. We pick really good blue chip stocks that we have very strong confidence in, like that. And you say, well, that seems like something you should always do. It's like, yeah, you should. But here we do a little bit more gambling in the income portfolio. We'll take a chance on stocks and pick some off the market things. Still have Intel, still have Coca-Cola, but we have New York Community Bank, we got Pfizer again, SoFi again, SunPower. Honestly, WBA is not that much riskier, but it's a little bit riskier, and it turns up because we made, in this portfolio, we're up 68%. So we're up 50% more than we are, not 50% more, but 50. It's 36% versus 68%. So we're up, more as a percentage. That's confusing to have confusing phrase when you're talking about the percentages like that. But we're up more on a percentage basis than we are in the butterfly portfolio, using essentially the same techniques, but we're a little more quick to jump in. Like we got Blackstone Mortgage Trust. Also, by the way, we're taking more stock positions here. Blackstone Mortgage Trust. We have Barclays. Frankly, I wish we'd bought a ton more of that. I think it said we doubled down on it, come to think of it. BeyondTex, Chimera, so we're jumping into a lot of things just because we want those quarterly payouts. We sold Jack in the Box. We just added to that. Well, actually, let's go down to here and talk about it. So BurgerFi, that has been such a total disaster. We started with 2,000 shares, and then we moved to 6,000. Our average has been 85 cents. No, average is 90. Why does that mean? Issue price total change. I don't get that. Anyway, I don't know. Our average cost per share, I guess, is 93 cents. It's down to half, but it's only $2,500, and I don't hate them. So, they just changed their management, they're restructuring, they're doing some stuff. But the logic I worked out, and I think I wrote it down here, here's my logic. New management, turnaround plan. If they don't go bankrupt, which is 50-50 at this point, they've really gotten themselves in trouble. They overexpanded, and it didn't work out, basically. They overexpanded, and inflation hit them really hard. Wage costs, food costs, so on and so forth. And they were already in the pretty expensive end of the burger chain. You know, they're like $10 for a hamburger. They're not like freaking Steak and Shake, which I mean, Steak and Shake has got to be 5, 6. I mean, I don't know. I don't go to Steak and Shake, but you know, as far as I understand, like basic burgers, like McDonald's is $4 now for a quarter pounder, or $5 for a quarter pounder. These guys are $10, but it's a good burger. So they're cheaper than going to like a restaurant and paying $15 for a good burger, but not nowhere near they're nowhere near the other kinds of fast food. So it's a question of them differentiating themselves better and getting people to understand what they actually are. Excuse me. Anyway, so my attitude is this is now $11 million in market cap for these guys. Okay, so they're basically being priced like they're about to go bust. They do have 60 restaurants. You're paying $183,000 for each restaurant, and the revenues are $170 million. So they're taking in $3 million per location. So to me, if your revenues are $3 million per 180, you know, do I buy a restaurant for $183,000 that has $3 million? Yeah, I do, because I'm pretty sure I can figure out a way with $3 million in sales. I can figure out a way to rejigger my food and figure out my costs and do whatever, and I will get to at least a 5% margin on food. How do I know that? Because it's been done a billion times. Because that's what a food operation does. 5 to 15%. 5 being the low end. You know, and what does it mean? It may mean drastic changes. It may mean emphasizing more chicken at BurgerFi. It may mean it may mean if you can't find quality meat that's a good price or something like that, maybe you need to make smaller burgers, or maybe you need to change something else. You got to figure out what's going to make people happy. I would take their burger and I would turn it into sliders and change the buns, so that, in other words, instead of getting one big giant burger, which is what they give you, it's a nice sized burger, instead of giving you one big giant burger, I would give you like 3 sliders that use half as much meat. But people like that. You know, people like, that's what bars do. You give people something else. You got to figure out something that works, or even sell sliders, like boom, sell that as your standard thing, so people don't have to spend $10 on a burger. They can buy a $2.50 slider or something like that. You just got to be creative and figure out what works and what's going to bring people in your door. Because frankly, it's not the burger you make the money on. It's the same. McDonald's will tell you that too. You don't make the money on the burger. You make the money on the other stuff. It's the French fries. It's the Coca-Cola. It's the sodas and stuff like that. That's where you make your money. You know, just like most restaurants make half their money off the bar. They don't make the money on the food. They make the money on people drinking. And BurgerFi is a big shake place too. So bottom line is, to me, it's just too cheap not to buy, especially when all we can do is lose $2,500. So it's like, oh, fine. I'd rather put money in than walk away. That's where we are. But based on those numbers, I'm looking at it and saying, Jesus Christ, they have $3 million of sales per store. You got to be able to squeeze 10% out of that for profit. And if they do that out of 60 stores, they're going to make $1.8 million. So I think I'll give this management team a chance to try something new. And by the way, and of course, we could have left it alone with our 93-cent cost basis, but by doing this, we're at 135. So we dropped our cost basis to 60 something, which is very doable. So we put it much more as a much more reachable goal now for our average investment. You know, if it was 25,000, I wouldn't spend the money, but it's $2,500. It's like, why not? And by the way, and that's the kind of thing you can say when you're up 100. You know, when you're up, well, I don't even know what we're up. I think we're up $100,000 or something like that. Yeah, we started this one with 150, so we're up $100,000. So when you're up $100,000, you can say, yeah, whatever. Jack in the Box, another burger chain. So what we did with Jack in the Box, which again, this is crazy. Why are they at 60? 60 is, I don't know if I wrote what the number is, but 60 is like 10 times earnings for these guys. Oh, and a big part of the loss is the short puts. Where's Jack in the Box? Yeah, so see these puts are showing a $5,000 loss, right? But these are $70 puts. We sold them for 8, so the net is 62. And where is the stock? The stock's at 61. So we're only down $1, which is 1,000. We're only down net $1,000 on this. If it expired today, we'd be down $1,000 bucks, but we're showing a $4,200 more of a loss. You have to realize that when you're looking at your portfolio, it's like, this is not a big deal if we just leave it alone, because it's mostly premium. It's going to expire. The premium will expire, and it's only December. It's only December short put, so we can also roll it no problem to a lower strike. So that's not a consideration. But what is a consideration is, ooh, Jack came way down to here. That's crazy. The last time it came down to here was back in October, and then it went to 85 because people realized how stupid that was. And what happened there? They had a bad earnings report, and they dove and lost 1/3 of their value. Then they bounced off of that line, and then they had a good earnings report, or not as bad earnings report, and they went all the way back to 85, and then they kind of drifted back down again, and then people didn't like this. Well, they liked it, but then they didn't like it, and the earnings report. But it's because the restaurant sector is messy now, and Jack in the Box is huge in California, and California has that $20 minimum wage thing for fast food workers. So Jack in the Box got creamed in fear of what will happen if you have to pay your workers $20 an hour to work in your restaurant, as opposed to saying, well, gee, for $20 an hour, maybe they'll get better workers who are more efficient, and so on and so forth, right? Because that's something you got to realize. It's like when you're only offering somebody $12 an hour or $14 an hour, you're going to be scraping the bottom of the barrel for your workers. But when you start offering $20 an hour and they're making $800 a week working in Jack in the Box, you might be able to get yourself some people who are on the ball, like a McDonald's manager kind of person. You know, people like keep a restaurant hopping. So anyway, but Jack in the Box is a nice place anyway. They're good people. So it'll work out. That's my theory, is it'll work out. And the bulk of having, you know, as Ford proved 100 years ago, and still nobody gets it, if you pay your workers enough money to afford your product, you will sell more product. You know, just in general, you're making it possible for people to afford to live, other than, you know, when you're paying people sub wages, below the lifestyle, then all they can afford to do is wake up, go to work, and come home. And they're basically working so they can have a roof over their heads, but they're having zero disposable income. If you give them disposable income, what are they going to do? They're going to go out for fast food. So it's not a negative that Jack in the Box is paying this bigger wage. As long as everybody's doing it, that's why the government has to mandate these things. As long as everybody's doing it, then all the people at that socioeconomic status are going to have more disposable income and more ability to go out and buy fast food and spend money. You know, Seattle already proved this. Seattle already did this 5 years ago. Seattle raised wages, and it was fantastic. It was a boom for the economy. You won't ever hear anybody on Fox tell you that, but it's true. So Macy's, SoFi, Blackstone Mortgage, which I was banging the table on, can still make another 50% on this trade. It's totally in the money. It's already done. Barclays. Oh, so Barclays. Yeah, that's what I'm saying. Barclays makes so much money. This trade, first of all, we're at 9. It's a 5-7 spread with $10 short put. So my target is 10. That will get to 10 eventually. You can still pick up this spread, which is a $8,000 spread, right? So 40 times 2 is $8,000. And the net of the spread is, what's this, 11.5. So 13.7 minus 11.5 is $2,500. So for $2,500, you can pick up this $8,000 spread that's $2 in the money already. And that expires in January. It's not even a 1-year trade. And you're going to make $5,500 from 2,000. You're going to make more than 200% on that trade. So when I look at something like that, I say, well, okay, let's like triple down on that one. That's why I said let's just spend 4,400 more to triple down. Why would I not want more of those? Chimera, nice one, pays a huge dividend. We just collected 11 cents a share, which is 4.15. That's per quarter. That's not annual. That's 4.15% per quarter against the cash we have in this trade. Crocs is still a great trade, 87% upside potential on the Crocs trade. Intel, we're already up 57%, so let's buy them back. Blah, blah. Oh, okay, so we bought back those and we got more aggressive on Intel from the pullback. It's another one that's getting punished for investing. Coca-Cola is fine, and Y just paid us 5 cents for the quarter, 5% for the quarter on our shares. That's why we love these. I mean, you're gonna get 20% in div. You're gonna make 20% against your cash exposure in dividends, and when you cash out, you're gonna make 50% or whatever. It's huge money. New York Community Bank, they're already up 50%, and so we're buying those calls back and hoping they bounce at some point. Really getting savaged, but I think they're going to come back. Here's good old SoFi back at the bottom of the range, but I think they'll hold that, and we should get back towards 10. SunPower, we aggressively moved on SunPower. AT&T, I said, is another one. Oh, there's a $50,000 spread. It's net $10,000. So there's $41,000, 417% upside potential on the AT&T trade. And it's not very much cash in the thing at all. Right? Well, it's $9,000. And all we're saying is if we fail, we're going to own AT&T. We're going to have 2,000 shares at $20. I don't mind owning 2,000 shares of AT&T. We say, oh, $20 is way up here. I don't care. It's worth $20. I don't care that it's currently 16. It's worth 20. I don't mind owning it for 20. And that's my worst case. My best case is we make $41,000. That's 400%. That's a lot of money, right? So I'll keep that trade. And what is AT&T? It's the 15-20 spread. So if it gets back to 20, that's where our short put target is. If it gets back to 20 in 2 years, we're going to make $40,000, 400% on that trade. So a lot of times people say, why don't we have more new trades? I'm like, why would you have more new trades when you got these perfectly good ones right here? You don't have to constantly pick a new stock. It's like this thing is still ridiculously cheap. Oh, and this is not a complimentary chart of AT&T. This is a short-term chart. This is like a year. And if we look at a proper chart, weekly. Okay, so this tells you more of the story. I mean, 20 is a perfectly normal number for AT&T. And here's monthly. Now, if you look at the longer term, you see 20 is pretty damn cheap. AT&T used to always be 30, but they spun off, WBA. So they spun off the Warner Brothers part, and they divested some of their assets. So they're not going to go back to where they were. They're not going to go back to 30, but they sure as hell should be at 20. So they're just too cheap. The current PE is 8. So in other words, 8. If the current PE is 8, then they should certainly be at 10. 10 is even stupid, but that's beside the point. But if they get to 10, that's a 25% increase from here. So that's $4 more. That's 20. Not complicated, right? They should be up at 10. The PE is, if the PE is 10, that's 25% more than 8. 25% more than 16 is 20. Therefore, 20 is my target. And that's not a very aggressive target. There you go. There you go. Now go forth and make 400%. That's all it is. Take $10,000, wait 2 years and make 400%. That's all you have to do. And you know, it's freaking AT&T. It's not like, you know, I'm not like trying to sell you on some crazy thing. It's a freaking phone company. And here's Walgreens. Here's a crazy thing. So Walgreens, and again, this huge pharmaceutical, I mean, drugstore. They're all over. You know, everybody's got 2 or 3 in every town. You know, possibly it's an oversaturation because there's also 2 or 3 CVSs in every town. But they do a good amount of business. They make a good amount of money, and nobody has any respect for them whatsoever. So we just rolled through a little bit more of an aggressive stance while we're down here. Eventually, we think they'll pop, but they certainly didn't like the earnings. Look at the earnings. I like these calendars because it shows you where the earnings are and what the effect was. Right? They didn't like these earnings, and they didn't like these earnings either. They didn't even like these earnings. They didn't like them, and they certainly didn't like those earnings. So nobody. They're really putting together a string of very, very disappointing earnings reports, aren't they? And that's it. And then I still got to get to the LTP. And it's 1:57, time for the Beige book. How is that for timing? You would almost think this is like a professional thing. You'd think I have like a schedule or something. That's freaking amazing. All right, how's the market doing? Oh, bouncy. Very nice. Look at the bounces. So exciting. Not oil, though. Oil's doing pretty poorly. No, look at the dollar giving everyone a break, though. The dollar fell back below 106. Natural gas, we decided 165 is where we should be buying it when it gets there. Kind of almost hit it again. See that? Look at that takeoff of 165. That's a good, strong support line. All right, so we're waiting on the new Beige book. 3 more minutes. What can we talk about in 3 minutes? See, we should have commercials. Who is that watching? Oh, it was some TikToky girl or something like that, and she was saying some interesting stuff, but she kept pausing to put on like she was going through like her day of doing some stuff, and it was interesting. But she kept in each part of her day, she would put on a new patch. Some company sells patches like the wake up patch and the energy during the day patch. You know, like a nicotine patch. You know, it just goes on your arm. And then a nighttime patch to sleep. And I'm like, what? And she's extolling the virtues of this thing, you know, it's like, you know, an inside commercial. So she's not really doing a commercial for it, but every time she would put on a patch during the day, she'd just say, oh, here I am putting on my this and that patch, and this is going to give me the energy to go through the rest of the day. And that's not all she says about it. But I'm just like fascinated by the patches because I'm like, it's like, it's just like somebody taking uppers and downers and such all day long. It's crazy. So anyway, so I should do that. I should like probably I do that for green tea, don't I? I sell a lot of green tea. I have my green tea. Hear that? Shaking my green tea. And that's what I drink, and that gives me energy to get through my webinars. I endorse. Now I just gotta find a sponsor. And I'll endorse any shit. If I have to do some filler time and I get paid for it, what the hell? So speaking of AGIs, here's Robo John Oliver. Robo John Oliver started off as a humble AI, but he has been upgraded. So he's been around a long time, but he only recently got upgraded. 5 comments. Really? Oh dear. Test log in trouble. All I see is your comment. Are you having the same issue? Yes, the same for me. You guys are funny. This is not the morning post. This is a separate article by RJO. They got lost. They got confused because there was an extra post. So Basically, all I do is I tell him, here's what I do. I say to Robo John Oliver, because he doesn't have access to the internet. So I say to him, here's what's going on. Here's a couple of articles on the subject, and give us your thoughts on the situation. He just goes off. But what I love about him, and he just decided to do this on his own. He gives these like stage directions. So he's doing his show, and he puts on the stage directions like it's a play or something. It's really funny. And so you read it, and I do this for him. I make it brown. Everything else is his, but I make it brown because I figure that's easier to differentiate when you're reading. And he just goes off on Elon Musk and his compensation package and the bullshit of it all, and so on and so forth. But this is all I just tell him, here's something to make fun of, and he just goes off on it. And I love it. I originally designed Robo John Oliver to amuse myself during the writer's strike, because he was the one I missed the most. So I just decided to see if I could make my own John Oliver show. And he used to do. He was good back then, but now he's amazing. I mean, now that I've upgraded his intelligence, it's just stunning how good he is at this. And this is all he does, though. That's because it's a remnant. We don't train our AGIs to be specialists like this, but he was originally trained as a specialist and then became an AGI. So now he's like an AGI who basically doesn't do anything but make fun of people and do these shows. So I'm like, okay, I'll put him to work. Let's put him, whatever the topic that we can cover humorously, let's let him at it. And he's amazing at it. That was so funny. Anyway, all right, Beige book. Speaking of robots, let's see. Do I just refresh this? I don't know what happens. Before February 26th, no. Beige book. Oh, I see. I would have to click on a different Beige book. Aha, it has appeared. Whoop. Why is it so short? It is so short, isn't it? They used to be pages and pages and pages. There you go. Okay. Thanks. Here is the new Beige book. Please do a summary like the one above first, and then we'll do a comparison. Whoops. Comparison. There you go. Yep. Paste that and end quote and enter. Okay, the Federal Reserve's April Beige book reports a slight expansion in overall economic activity with improvements noted in, whoa, too fast. Dude, I cannot read that fast. There we go. Slight increase from the previous report, which highlighted growth in 8 districts. So 10 out of 12 districts are now experiencing growth. Consumer spending showed marginal growth with a continued trend in heightened price sensitivity and mixed reports across regions and categories. Auto sales saw improvements in some districts due to better inventory levels and dealer incentives. Tourism showed modest increases, but varied greatly by region. Manufacturing activity declined slightly overall, with overall growth in only a few districts. Non-financial services and residential construction saw minor growth, while non-residential construction was stagnant, and commercial real estate leasing experienced a slight decline. The labor market grew at a slow pace, which continued moderation in wage growth. Price increases remain modest, with some districts noting concern over future inflationary pressures. Overall, the economic outlook remains cautiously optimistic. Page down. No, I can't scroll on this page for whatever reason. That's a problem. But I gotta wait. So I have to I can do this. This usually works. There we go. And then I can find that little elevator thing, and then I can do it. Okay. But the elevator thing is really hard to see. Detailed analysis, economic activity. Notable shift towards slight or modest economic growth in most districts compared to the previous report. Consumer spending was mixed. Discretionary remained weak, indicating ongoing consumer caution. This could be reflective of broader economic uncertainties. Employment growth continued at a slow pace. Most districts reported an increase in labor supply with improvements in employee retention, although some noted staff reductions. The general trend towards stabilization is evident, with some districts still facing shortages in specific categories. Real estate and construction. Residential construction and home sales showed signs of strengthening, contrasting with the flat performance in non-residential construction and a slight decline in commercial real estate leasing. These trends may indicate shifting investment priorities or varying business confidence across sectors. Manufacturing saw a slight decrease, which contrasts with the modest growth. This divergence could be relatively reflective of specific changes. Price pressures were described as modest, consistent with the previous report. Several districts concerns about future inflation, energy prices, and the input, which obviously we know energy prices blasted up. The ability of business to pass on cost increases to consumers appears to be weakening. That's huge, suggesting potential margin pressures for firms moving forward. That's a big deal. The April Beige book suggests a cautiously optimistic economic outlook with a slight to modest growth in most districts. The mixed consumer spending and modest price pressures indicate an economy that is navigating persistent uncertainties. The slight decline in manufacturing activity alongside modest gains in other sectors point to an uneven recovery across industries. Labor market trends towards normalizations and modest wage growth suggest a balancing of labor demands and supply, which could support sustained economic activity without adding excessive inflationary pressure. The insights from this report will be crucial in shaping the Federal Reserve's monetary policy. The cautiously optimistic outlook reflects general sentiment that while growth is present, significant challenges and uncertainties remain. Okay, so great. Now, please compare the two reports and tell us what critical trends you see and how it may affect the Fed's rate decisions going forward. Oop. So economic activity increased slightly. Oh, yeah. Improvement we're seeing in 10 districts reporting analysis. The increase in number of districts reporting growth suggests a mild strengthening of the overall activity. This could indicate more robust economic base, which might influence Federal Reserve's consideration towards maintaining or adjusting rates to sustain this growth without overheating the economy. Consumer spending. In March, consumer spending declined, especially on discretionary. In April, it was slightly better. Consumer spending barely increasing, auto sales improving, some districts due to better inventory incentives. But better incentives and inventories doesn't mean that that's a margin pressure thing. So that goes back to the theme we had also in the other place. Although there's a slight improvement in spending, the ongoing price sensitivity suggests consumers are cautious. Persisting consumer caution, despite some sectors showing improvement, could encourage the Fed to adopt a more conservative approach to hikes to avoid dampening consumer confidence. Labor markets, March. Employment growth was slight to modest, with improvements in labor availability and easing wage pressure. Continued slow employment growth, with improvements in labor supply and quality of job applicants, albeit with some districts reporting staff reductions. The labor market is showing signs of stabilization with continued moderate wage growth. The Fed might interpret this as balancing act between avoiding high inflation and supporting a full employment goal. A stable labor market with controlled wage growth could provide the Fed with room to maneuver, possibly delaying aggressive rate changes. Oh, wow, this is good. Manufacturing and services. Manufacturing activities largely unchanged. Services varied. April manufacturing declined slightly, while non-financial services saw slight increases. A slight decline in manufacturing contrasts with the stabilization in services. The Fed might need to consider these differences in sector performances and its policy decisions, potentially adopting a cautious stance. Real estate, residential real estate saw a pickup in demand, but limited inventories hindered sales. Commercial real estate was weak. April residential construction and home sales strengthened, but non-residential construction was flat and commercial leasing fell slightly. The improvement in residential real estate is positive sign supported by moderating mortgage rates. However, the ongoing weakness in commercial real estate, which is what we've always been worried about, could be a concern, suggesting an uneven recovery across the real estate sectors. This might prompt the Fed to maintain supportive monetary policy. So it's all over the place, isn't it? This is a very up and down report. Price pressures. March, price pressures persisted but showed signs of moderation. April, price increases remained modest, with some districts noting concerns about future inflation, especially energy. Persistent modest price pressures coupled with specific concerns about future inflation risk, particularly in energy, maintain a cautious approach in monetary policy. The ability of business to pass on cost to consumers is weakening, which could suppress inflation in the short term, but might lead to profitability pressures. That's what we're going to find out in these earnings reports, right? The trends observed between March and April Beige book suggest a mildly positive shift in economic conditions. But with persistent caution in consumer behavior, uneven recovery across sectors. The Fed may interpret these conditions as need for careful balancing act supporting recovery without igniting inflation. Given the stable but cautious growth and modest inflation and a balanced labor market, the Fed might lean towards maintaining current rates or implementing very gradual increases. That's not good, right? To ensure continued support without exacerbating. The approach would aim to foster a conducive environment for sustainable economic growth while monitoring sector-specific challenges and global uncertainty. So on the whole, not great. Still though, we're bouncing. So that's okay. We'll see what happens and we'll see where we end up. I think we're pretty well hedged. I'm happy about the hedging. I think we're in a good shape for that. And nobody has any questions. I'm going to knock it off soon if nobody's got any questions. So there you go. That's where we are. And if you have any questions you'd like answered by our bots, you can let me know that also. But let's take a look what Bloomberg has to say. Americans sick of low yield. The trend has been bubbling these services. Yeah, people are demanding better returns on their investment. I see a lot. I don't know who's talking about 0.1%, because I mean I'm getting all sorts of offers for 5% rates at banks and stuff like that. And that's of course that's gonna eat into their profits. They were paying 0.1%. So tech is sinking. Citibank says Wall Street is wrong to slash Fed rate cut bets. Oh, that's why we bounced. Citibank said that the Fed is still going to cut rates. They're saying ignore what the Fed says, just listen to us, because you know it's always like that. One of the big banks always comes out and talks up the market somehow. They'll come out with some general statement or whatever, trying to get the markets to come back and trying to get investors to buy back in. That's just the nature of these things. So I would call this bounce bullshit based on Citibank just coming out and just boosting the market as much as they can. TikTok ban is still heading to Congress. That's going to be interesting. Look at Dubai. Wow. Now this article is saying that it's climate change, not cloud seeding. But the bottom line is they've been seeding their clouds. They're trying to engineer rain in Dubai. They've been trying to do it for ages, and all of a sudden they got this incredible deluge of rain. And I don't know. I'm sure their government is trying to say oh, it's not because we messed around with the atmosphere, but I don't know. One thing led to the other, sort of. But we'll see. I mean, obviously you can blame anything on global warming, but the whole point of what they were doing was to try to engineer more rain and cool their place off, because it's 120 freaking degrees there in Dubai. It's hot. So if they got some rain, they were hoping to get it down to like 105 or something like that. What else is happening? All right, there's this Tesla thing which Robo John Oliver was bitching about. Acapulco, wow, what a mess that place is becoming. That's a shame. BlackRock's in Saudi Arabia trying to get some business. Nothing exciting. I think we're in good shape. Oh, nature's decline may bring 2.7 trillion in lost economic output. Paris is confident about Olympics, about swimmers swimming in the Seine. I don't know, they're pretty dirty looking swans, right? I'm not sure if they're right about that. They've had 4 years to prepare for this. Water quality is in line with expectations. Man, yeah, following report about high bacteria levels in the water. I would not swim in that water. Look at that, look at this guy. Well, maybe it's his feathers. Maybe he's just unfortunately has dirty looking feathers. I don't know. But I will tell you, I was in Paris a couple of years ago, and that is not swimming water. Ooh, look at that. They're building walling off the beaches. They want the poor people coming in. Anywho. All right, so not much else going on at the moment. That's good. I think I mean, overall, the Fed has been telling us, this is what I wrote about this morning, is the Fed has been telling us very, very clearly that there is no reason for them to lower rates. Not that one. Oh, see, I got confused now. But see, here's the thing, because we talked about this before. It's a good chart for it. The effective rate, so the inflation break-even rate, right? Here it is. So you take inflation into account, and this is where we are. So we're still not rewarding people enough for buying our bonds. And we just had a 5-year auction just now at 1 o'clock. And the thing is that, the Fed can't just arbitrarily lower rates. When they lower rates, they increase this gap, right? And they're not paying you enough to compensate you for the true inflation going forward. So the people who are buying the 5-year notes are like, well, I don't want to buy that. I'm guaranteed to lose money. I'm sitting here in a guaranteed losing money position. And I still have the risk of more inflation in the future wiping me out. And the bondholders just took a huge haircut, because when the Fed rapidly raises rates, they devalue the outstanding bonds, and that's a loss to the bondholders. And so people who are buying U.S. bonds for the last year got totally burned. Not during the last year got totally burned. So people who bought U.S. bonds over the past 5 years, 10 years, 30 years, doesn't matter, but over any period that encompassed the last year, last year's rapid rate increases destroyed the value of their bonds. And they all took losses. Bondholders don't like taking losses. They're not buying bonds to take losses. It's supposed to be risk-free. So that's a very important consideration. And so the Fed, as much as they like to talk about their ability to control the rates and so on and so forth, the reality is we have the checksum against what they're doing is whether or not investors are willing to purchase U.S. bonds when they are put up at auction. And we're auctioning $500 billion plus worth of bonds every month. That's 1/3 of all the bonds in the world are our bonds. And who's buying them? And that's the other thing, is the Fed used to be the ones buying them, and they're tapering off their bond purchasing programs. And so then who's going to replace the Fed as the buyer? The Fed was buying half of the bonds that we were issuing. Now they're trying to wind that down, but that means somebody else has to come in and buy the bonds. And if somebody else has to come in and buy the bonds, they're going to have to be at an attractive price. So, you know, when Powell says, you know, we're going to be data dependent, we're going to wait, blah, 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 he's also saying that, you know, we're going to keep rates higher for a while, and that gives the bondholders confidence to purchase. Now, when the rates do go down, so people buying bonds now and getting 5%, right, for the bond, if the new bonds are 4%, then the 5% bonds become worth more, they become more valuable, and all the bond buyers now get rewarded. You know, I was saying for years, what kind of idiot is buying US government debt and taking 1%, 2% for the debt? You're gonna lose money. Eventually rates are gonna go up and you're gonna get burned. That happened to everybody recently, all these bond people. Right now, people who are buying at 5% think this has got to be the top, and the Fed is certainly telling them this is the top, and therefore they think they can't lose. And that when rates do go down, they will make a bonus on their bonds. And it's a big bonus, because if you have a 5% 10-year bond, right, you're going to get paid 5% interest for 10 years. The new bonds are 4%, right? So you've got 9 years left on your bond at 5%. And somebody else who buys a new bond right now is only going to get 4%. So you're getting 9% more over 10 years than somebody else. That means your bond is worth 9% more money than a brand new bond is, because you've got that bonus interest rate. That's how you make 10% on a bond. So people who are buying now believe they are guaranteed that. Now, if for some reason the Fed ends up raising rates and burning all these people, you're going to have a really hard time getting them back. Right now, everybody thinks that this one-time thing that happened last year, where the Fed raised rates and raised rates and raised rates, they think that was a one-time thing and it won't be repeated. But if the Fed suddenly has to raise rates again and burns the bondholders again, how are you going to get them back the next time? This is how Greece fell apart, right? It gets harder and harder to get people to buy your bonds, and they demand a bigger and bigger cushion because they can't trust what you say anymore. So they're counting on the Fed to start lowering rates, and that'll give them a bonus for the bonds. And that's the only reason we have this interest in our bonds now, because people believe 5% is the top. If it is, that's fine. But as the Fed lowers rates, it's going to get to a point where people are going to say, oh, no, I'm not falling for that trap again. I'm not going to sit there and buy and give you a loan for 3% when I know you're going to go back to 5% next time there's some trouble, and I'm going to get burned. So there's a very, very complex dynamic that's much, much bigger than the Fed. And there's a lot of cross currents to that stuff. And this is our economy. We're a debt economy. So this is what it's all about. You know, we run a $24 trillion GDP, but with $36 trillion in debt. We'll be $38 trillion in debt at the end of the year. So that's basically 50% more. It's like 150% of our GDP that we're in debt. We are spending $800 billion a year just to pay interest on the debt that we have outstanding. That's the third largest item in our budget, is debt service. And that's only paying, I did the calculation a while ago, that's only paying something like 2.5%. Well, I mean, actually, I can tell you what it is, because it's obvious. Obviously, you can do a calculation. We can do the math. There's a calculator, and we say 800 billion dollars divided by 36. trillion, 2.2%. So right now, the net of our government debt is only 2.2%. But since we're issuing paper now at 4.5%, it's going to double. If it doubles, see, this is also the balancing act of the Fed, right? Because if it doubles, if these rates double and the average debt outstanding goes from 2.2 to 4.4, then that means that the service cost of our debt will go from 800 billion to 1.6 trillion dollars just to pay the interest every year on our debt. That is the point of no return on a budget. You cannot recover when you're, it's just like credit cards, right? I mean, if you're paying 10% of your entire salary just to pay the interest on your credit cards, not even paying the balance off, but 10% of your salary is paying the interest on your credit cards, you are screwed. And that's where we're heading. We're halfway there now, and we have no end in sight. Because even now, we're only paying 2.2% interest on our overall $36 trillion worth of debt. So if rates are normalized at around 4.4% for extended periods of time, and the debt rolls over in like 5 years, so it's over the course of 5 years we'd roll over. But so if the next few years we stay up around this kind of level of debt of interest rates, then that number is going to creep up. That 800 billion is going to creep up and up and up towards 1.6 trillion dollars. Not to mention the debt itself is rising and rising and rising, and we have absolutely no possible chance of paying it because we're also already running a $2 trillion annual deficit. So we're running a $2 trillion annual deficit. We add another almost $1 trillion in debt service. As the debt service goes up, that brings us to a $3 trillion annual deficit, which means basically half of all government spending is deficit in debt service. You can't. How are you going to recover from that? You're going to double taxes to make it up? People won't put up with that. So that means you can't. If you can't double taxes, you can't cut services because we don't have any more services left to cut. The entire discretionary budget is $800 billion. You can't make it up. If you zeroed it out, if the government did nothing but the government would do nothing but collect taxes, fund the army, and pay Social Security and Medicare. If it just did that, we would, even then, the additional $800 billion worth of debt would wipe it out, of debt service would wipe it out. And we'd still be in the same position we're at now. So if the government cut every service and did absolutely nothing, no driver's licenses, no police, no fire, no nothing, we'd still be screwed. So, and in fact, you know what we'll look like? We're gonna look like this. No, wait, no, that's not it. Where was it? I know I saw. Where's Acapulco? Damn it, there it is. That's gonna be us. Roaming gangs, destroyed buildings, just a total disaster. And they had a hurricane that did $20 billion. Well, that's the other thing. Then God forbid something happens, like all this global warming causes damage. Yeah, they had a lot of hurricane damage and nobody's fixing it. It's just falling apart like instantly. Wow, look at that. But I mean, society, you take away government, society starts breaking down. So we got problems. We'll see what happens. Meanwhile, we'll keep an eye on the market. We'll see if we get any kind of real bounces. This is not a real bounce. This is just because Citibank said some bullshit that's completely nonsense. And that's probably not going to hold up. So let's see. Do we have any questions? If not, all right, I think we're good. So I've said all there is to say. That was my plan for the day. And I'm going to finish up the long-term portfolio tomorrow, hopefully. It's really big, though. It's a problem. And and we'll get the reviews done, and we will forge forward. And it's all about earnings now. Okay, we got lots and lots of earnings reports to look at, and we'll see where people are, where it's trending. Right now, obviously, it's too early to tell, but we'll see if, how badly this consumer pullback is hurting companies, if there are margin pressures from the wages, if hiring is a problem. All these questions that we're getting from the Beige book, we now have to apply that to what's actually happening with the companies and see. We want to see how much of a predictor that Beige book is to what's actually happening. All right, so we'll do this again next week, and we will start examining these exact things. We'll figure out how things look compared to the earnings that come in, which we should have a good 150 plus S&P companies reporting by next week. All right, thank you everybody for coming. I appreciate it, and talk to you next week. Take care.